to another Pepperstone live event here over on the live streaming platforms. My name's Thomas Atkinson, and as always, I'm joined by Tyron Abella. But before we get into everything else, I just wanted to say there's a lot of volatility going on in the markets. Obviously, there's a lot more to potentially come this week with some big news still coming out, Ty. And it's interesting how dynamics shift from inflation is kind of going away to suddenly inflation is back. And that's a great sign for commodities traders, for currency traders, and for indices traders, which we'll be discussing all of that today because, of course, it brings volatility. And for the first time in a while, we've seen the VIX spike, Ty, above 15. It feels like it's been years, but it's probably been about 5 months.
I know it does feel like it's been a long time. Welcome, everybody. Yeah, look, the market was certainly up, down, and all around. It's going to be, I think a very, very interesting next 24 to 48 hours, Tom. I know we've got a lot of news to come out, but, when a market's at all-time highs, like we know that, I think we talked about this last week, that you're always going to be on the lookout for any market reversals. And I think people, they can panic sell. There's no question about that. People see a little bit of red and they think, okay, this is it. Armageddon is about to hit, and off they go. They start selling everything down. So that's why we always like to give it a day or two to settle down and see what the market really is. Now, you know what? If we're down another couple of percent tonight, it might be a different story. On Friday, we'll be looking at it with a different lens. But for now, I think we'll jump straight into the charts and see if we can identify any opportunities inside this volatility and also inside that VIX that is finally starting to see some action, Tom.
Yeah, so just before we do that, a quick risk disclaimer, but today we'll be going through live charts. We'll be obviously going through the analysis of some of the major pairs that all of you are looking at. And if you have questions throughout, please feel free to ask them in the chat and we'll answer them throughout the video and near the end. So just remember, it's all about you guys. So if you have questions, feel free to ask them and we will answer. All right, we'll see you in just a second. Okay, so the VIX, Ty, let's start here this week because, of course, volatility is spiking back up and there's some great learning education kind of concepts with the VIX. Now, a lot of people assume that it's a great trading platform and that is that you should be trading the instrument of the VIX. That probably is not the way you really want to think about it. But what it is an excellent thing of doing is to tell you about volatility and to tell you about expected moves and to tell you about opportunity in many ways as a trader. So we often see the VIX come down between around a 12 and a 14 level. Now, historically, what that really is leading into is what we call like a bullish market or a period of stability. Now, when the VIX spikes like it did in the previous session, you want to start doing some technical analysis on it. And the reason we've got 20 up here is often it's considered a bearish sign if you're above 20. And when you're underneath 20 in general, it's considered a normalized market, isn't it, Ty? But you can do some technical analysis on the VIX. So let's have a look at the smaller timeframes. We're obviously on the weekly. What you'll notice on the daily is we went high. In fact, we spiked all the way up to 18 and then came back down, but still managed to get above this magical 15 zone. So it could mean, Ty, that volatility is back for a little bit in this market. What do you think of this chart?
Yeah, look, it's definitely signaling that volatility is back. I think, like I say, look, you're going to see that spike. 20 is an interesting level. Obviously, we haven't seen it in a little while now. And yeah, because a lot of people are wanting, almost wishing a market to go bearish, like I said, it can sometimes cause that manic selling the VIX. Yeah, you're going to see that spike, quite frankly. That's what's going to happen. It looks like it wants to trend up. Like, I think it's going to be very interesting to see what it does over the next 24 hours, or especially the US trading period in particular, I think, because this could normalize very, very quickly, Tom. I mean, all we need to see is a percent rise tonight. And all of a sudden, a lot of this was a wasted volatility spike, actually, and that may well happen. I mean, it's very, very likely that we could see that scenario. So that's why I think that. Yeah, I look, on the flip side of that, if we see 1.5% down tonight and we're trading at a new low tomorrow morning, our time, then this VIX is probably going to be well up above the 18 again, and probably at that point, I think that we're going to see probably a little bit more trend starting to key in to get us probably levels that not necessarily a sell-off zones, but potentially pickup zones as well. I mean, remember, we are traders, so volatility, to an extent, is important for us for the market to move, right? So we want to see. Otherwise, we're going to have a flat market, and if we're not trading iron condoms, we're not going to make any money, Tom. So we do need to see. We need to see ups and we need to see downs. There's no question about that. But that volatility spike, I hope it's not a wasted one. I hope we see a little bit more.
Well, I think some of the breakouts we'll be talking about in a second might be showing that there could be more to come here. Let's just quickly talk about VIX, because there was one other options world thing that I want to talk about, just because it does come into technical analysis. Now, we mentioned 15.5 to 16 before. It just so happens that also seems to be a bit of a level in terms of a resistance or a call area, call wall. If we do manage to breach past that, it could really bring in what we call opening up the floodgates of volatility ties. So definitely one that you might want to have on your TradingView platform or on the Pepperstone platforms out there, and make sure that you're watching the VIX, because this is getting exciting now. We'll move from the VIX to the US 500 tie, and then we'll switch back to the dollar index, because, of course, all of this stuff's happening. Now, the reason I want to go the US 500 straight away is to mention our favorite moving average, or more importantly, probably your favorite moving average, which is the 20 moving average, isn't it? And you can see here the exponential moving average is being tapped and seeing a series of higher highs and higher lows. Now, realistically, the trend is still up until we start to breach underneath this and we start to break through some structural zones. So I think there's a clear, I would say 48.80 to 49 kind of 20 zone, where we see it as, at this stage, buyers are committed in this zone. So if you did look at that over the last 24 hours, you'd be pretty happy with yourself. And if that gets taken below tie, do you think it's a major trend change occurring here for swing traders as well?
Yeah, I think so. Look, the 20 moving average, we could write, poems about it. It's such a strong force of nature. And I'd like to think at some point in the future, when I'm long and gone, someone like Thomas will be bringing up my picture when they talk about the 20 moving average in their live streams, because I think it's as important as Wyckoff's theory in itself. That's because it's one of the
right. Okay.
it's one of the it's one of the most important things, Tom, I believe, because you can apply it to every time frame. Every type of trader can use it, whether you're a scalper, whether you're an intra day trader, whether you're a long-term investor. It's got its uses, and it's very, very easy to read. And I agree. Look, it tapped it, no question. Quite often when a market is selling off the way it did, we do know it gravitates to the first point of what we call equilibrium, and that really is the mean reversion SMA or the EMA as we know. So it's important in the sense that it must maintain its level above there, or we could see further sell-off. There's no, in my mind, a break below that 20 moving average with a close below it, which is probably the most important thing, is going to signal to me that potentially the bears have actually won this war, and we're going to start to see a little bit of action. And it's healthy too, right? Like, let's make no mistake about it. It doesn't mean that the market's going to 3,000 or anything crazy like that. Like, this is not a black swan event. This is just a CPI data reading that, for all intents and purposes, if we were, I was talking about it this morning, the Fed, although completely, separate of what the stock market does, they're not going to be sitting there and saying to themselves, well, we need to correct this this stock market because it's raging all-time highs. Let's fuel the fire. Let's throw some diesel on it by lowering interest rates. That doesn't make sense. They're not going to make a decision based wholly and solely on the stock market. But at some point, it's going to affect their judgment. Everyone knows where the stock market is. Everybody's talking about the euphoria that's there. So, lowering interest rates right now is like throwing diesel on an out-of-control fire. So I can see why, potentially they're not going to drop them as fast as people think. But the market reacted extraordinarily heavily to that news. So realistically, the 20 moving average is its equilibrium point. If that level holds, I think that we're going to see, probably renewed pushes back to the 5,000, maybe slightly above. But I would still be nervous around that level. I'm not, we've made no secret of the fact that we don't want to be the first person at the bar. So we're quite happy to let everybody else who is maybe less informed about what the market might do take the hits for us. And if indeed then we start to track up and past that level, then we'll look at it with a different view. But for now, that 20 moving average is extraordinarily important in the context of where it's at right now. And it has been for a long trend, as we know, since basically November of last year, it's done nothing but make higher highs and higher lows, this market. And the only times it has pulled back, only the 20 has actually stopped it. So, this is the first real test of a pretty decent drop. So it's going to be very, very interesting. I'm looking forward to finding out.
And we still haven't seen mean reversion to the weekly yet, which we'll discuss in a moment, because that's something that you generally do get. That's back to the 20 on the bigger time frame. So I think some key levels here to watch: the 49.20 to 48.80. That's going to be a big zone around the 20 moving average, around some options levels, and also there's a thing we call negative gamma tie, which is going to occur if you actually, at least with the current stats that we have, at around 48.80 to 48.90. I've spoken to a few people, and that's where they believe it is at this stage. So if that's to be true, the 20 and around that level, it doesn't matter which technique you're really using, it's already showing you that there's so much key structure going on there. So because we've had the buy the dip style scenario that's occurred so many times throughout this trend so far, there's no surprises the 20 got hit. There's no surprises it's finding a buyer. The question is then, which areas do we need to be careful of? And you mentioned it before, that 5,000 level, but also the 5,020. So somewhere actually in here. And the reason is going to be down to the gaps. So remember, on Pepperstone, you're going to be trading things like the futures market, but there is also a chart that you could put on your screen, and a lot of people do this, which is the market hours, so the SPX. And you'll notice here that we have a gap from where the information has been released to where it opened, and which is down here. And then, of course, we could be looking at that type of thing. So just remember that the zone there is 50.20. So 5,000 to 50.20 could be where the bears sit, Ty, and it looks like the bulls are around that 49.20, 48.80. And both of those zones are great zones to look for internalized structure. So you're looking for signs, you're looking for your systems, you're looking for whatever else types of things that you generally watch for, and that would be on those screens. Now, we mentioned quickly mean reversion before, Ty, and I just think this is an interesting one. We haven't had one touch of the weekly 20, and it's pretty historically rare. So to not get the 20 being touched, and maybe we'll delete these big arrows, is pretty rare, because if you have a look at it, even during the big rally of 2020 and 2021, we still found mean reversion several times throughout it. And you can see how good the 20 was on the weekly. So a lot of people, if we get through the daily 20, a lot of people are going to be looking for this particular TP zone, which is going to make sense to the structure and demand as well that we're seeing currently on the charts, because that was where we were at the beginning of January. So this would be totally healthy, even if it did occur.
Absolutely. And I think that's probably the thing we need to highlight. Now, before you get your pens out and you start writing the death threats and everything else that, we're calling the end of the market and everything else, you've got to remember that 4,800 pullback is actually a very, very healthy pullback for a market that's going up. In order for a market to actually make new highs and blast off, on its way to 6,000, it's important that these levels actually do get tested on the way up. This is not a drastic pullback. I mean, you're only talking a handful of percent really at most. So although it looks like it's a big pullback, it's actually a very healthy one. So the market indeed, for a healthy market, will actually pull back to a level around that sort of 4,800, 4,850-ish level. And that would be considered on a fib, that would hardly be even scratching the surface of 38.2, depending on what swing you're measuring. So it's actually a really good level. And we probably should be welcoming that as traders, because that gives us an opportunity. We look for a smaller time frame change of trend at that point, like a series of higher highs and higher lows on a 4-hour or an 8-hour chart like that. And that gives us a golden opportunity to start looking at long opportunities back to these previous highs. So the market's already tested the 5,000 now. So the next transition up there should be an easier one with met with less resistance. So we as traders welcome a move that would actually come back down there, because it gives us another opportunity to, add to existing positions, take on new ones, moving in that direction. But I think I would want to stress, and I know Tom feels the same way, just because it's a level that you might consider going long from, that is not the place you want to put a pending order long there without actually identifying the market has actually shifted. What you want to do is allow the market to actually get there, and then look for the smaller time frame changes of trend. Let it consolidate, let it do its dance, let it accumulate, let it distribute, all that level. And then when we see a series of higher highs and higher lows on a smaller time frame, we get the confidence that the market momentum has reshifted the balance to the upside, and then we get in. Okay, it is very, very important that you do that, because if that level doesn't hold, the next proper level is probably 4,600, which is a long way from 48.
Yeah, so it's called we like to look at markets as buying the V, not the dip. And what that really is saying is that, okay, you might have a dip down to this level. You might be excited about this level. You're playing chess, obviously, with the markets. You're, construing a concept, but you don't really want to buy necessarily on the way down. You instead want to be buying as it rallies back up. And that's going to look like some type of structure like this in the smaller timeframes. And that's the type of thing you are looking for. Of course, it's better to have a price action based approach to seeing a switch and actually seeing the momentum come in. As Tyrone would say, maybe the Wyckoff or the composite man, or at least some type of bigger investor, they're not. So, Ty, the US 500 obviously took a bit of a bath. We've got some good levels on that we've been looking at just before. Let's now go over to the yields, because, of course, we have been talking about yields a lot more in recent times. And this will go into the dollar discussion. But US yields were breaching out of some big levels. And it's something we discussed maybe briefly last week. And we've obviously talked about it on our own show as well a lot. And that's the 4.2% on the US 10-year and the 4.5% on the US 2-year. And why these are important is because now that we've breached out of these zones, there's not much really stopping these markets from getting a little bit more action. As you can see here, we are pulling back down in yields, which makes sense. But it's kind of opened the floodgates to a 4.7 previous resistance over here. And it is a pretty strong move coming off also a doubling bottom style pattern. So if you want to think of it this way, that there could be a little bit more left in yields, and it backed up by the US dollar. Because, of course, if yields are going up, it becomes more exciting to own the currency, which is earning more interest in the bank. And that's going to be the US dollar in this case. So we can use Pepperstone's dollar index or a futures dollar index so that we can have a look at it on the charts. And again, the 20 moving average, you can see how well respected this one's been. And guess where it came off in the previous session, Ty? It came back down to the 20 moving average, and we saw a nice spike back up, a breach of this previous zone. And I will ask people in the chat, what type of pattern could this be? Okay, we asked it last week. Let's see if we get an answer here. While we wait for the answer, Ty, just want to say there is, thank you very much for everyone that's joining us. And if you've thumbs up the video, that is much appreciated. So always do that if you can. If you enjoy this type of content, you want it to keep coming out this way. And Josh has a question that says, does it take a few days for the market to digest the CPI? So Ty, my opinion on that would be that generally the CPI is pretty quickly adjusted for, because it is kind of like a clean number. But in terms of how a market will digest a number, if it's deemed that the market then needs to move to another equilibrium, of course it will take days and days and days, because it will be moving there based on that news. The news is the catalyst, and then you get a movement. But it's very hard to tell that is due to the CPI being the catalyst. I usually like to just think of it, and so does Ty, as just price action is the key. Yeah, the Absolutely. CPI might be the catalyst, but it doesn't even have to make sense sometimes. I've seen sometimes they've raised interest rates, yet the currency is getting destroyed. And you might say, well, how's that possible? Yep. It's a buy the rumor, sell the fact style event. So I look less to the news, and I look more to how is the market reacting to those levels.
Absolutely. And I had a conversation today with someone, a handyman, and sometimes you get the best market biases from people who actually don't spend their life in the market, Tom. And he, knowing that obviously, we do trading, said, the market has taken a bath. I'm going home after this job, and I'm going to sell my entire portfolio because I've made all this money, and I think it's the end. So it's those sorts of things that make the market fall so quickly. People are looking for something to fear because people are nervous at these levels. Okay, so it's generally very naive money that's building a brand new portfolio at an all-time high. Like, most people aren't. A sensible approach would not be to be building a brand new portfolio at an all-time high in a market. That's obvious, right? It's just logical. But the fear and the hysteria can kick in very, very quickly, and that can make the market drop extraordinarily fast. So I think I agree with you that a couple of days for the market to digest the information, because look, at the end of the day, it's not, Tom, me or any of you guys that are actually moving this market. Essentially, it's the bigger players that are moving it. So they're going to digest the news. And that's why I said the news, for the next couple of days is so important where the market ends up, because you're right, it'll give it a couple of days to adjust. Is it really warranting the sell-off that happened? Will it recover? If we're looking at a weekly candle closes slower than the current levels, that's telling us a very, very different story. So like even earnings on stocks, I mean, we do the same thing. I mean, Tom would agree. We never trade straight after an earnings. We always give the market a chance to settle itself down, give it 2 or 3 days, work out where the real momentum plays are, let the big players adjust their positions, and then trade accordingly. You don't want to be a knee-jerk reaction. What do we say? Our motto is patience, patience, patience.
React.
And absolutely it is. And we want to make sure that we're patient here. We're not overreacting, and we trade what we see. Very, very important to trade what we see. These are the news events that are coming up this week. Now, it always seems that there's important news every week, but news is never more important after we see a big drop like this, because that's what's really going to balance out the market. If indeed the big players truly want this market to sell off from here, these are going to be extraordinarily important news results. When in any other given week in a flat market, they may not be as important. This week, they're going to be extraordinarily important because they could be the catalyst for either a steadying of the market or a market that's going to look like it wants to sell off a little bit more to a level that is maybe a little bit more reasonable. So they're very, very important news events.
Yeah, Wednesday, VIX expiration, Friday, OPEX, which basically is the biggest options expiration of the month. It can move the markets a little bit there. And then, of course, we've also got PPI. Now, to go back onto the US dollar and why it's finding this strength, just if you want to understand it, one of the things that's doing, and I just got this here because I posted it, Ty, so I thought might as well share it here with everybody. And what it is it's the change in the federal fund rates expectations in the future. So this is why the dollar index is moving up, because you can see here the 13th of February, US time, and then the 12th, look at the difference in the yield curve and look at the difference from December of last year. So we've gone from having lots and lots and lots of rate cuts and ending in what we call a terminal rate, which sits around 3.25%, to ending in a terminal rate, according to this market, at just under 4. So that's almost, that's 75-ish basis points of change. And that's a fairly big deal when it comes to you holding, let's say, money in cash for a period of time. So certainly that expectation's there. Another one of the interesting things that tends to come around these points, Ty, just from a statistical standpoint, is that markets like indices like the S&P 500 we mentioned before, they can sometimes come in variations. So you'll see that there are periods of time we tend to get rallies. There are periods of time that we sometimes get weakness. And then, of course, there are two really well-known ones, which tend to be around this period. And then, of course, the September-October period, which you may have seen before. And these are usually after earnings season. So again, these things are all synergizing together. But just because you have that information doesn't mean it's going to happen. And I think that's something I want to just really reiterate. Just because you have something and you think, oh, wow, I've got this one bit of information, it's working. Really what we're saying is you come back to price and you can understand why it's moving now, maybe with those yields, with that macro stuff. But really what it is price action. So the market went off in one direction, rallied up. I want to look at the structure here together with everyone, Ty, because this is an absolute classic. What a great learning curve to understand how markets react. So you can see here it was a number. So the number's pretty clear cut to me. And the number was bad, okay? Sticky inflation and a high amount of consecutive, what we call shelter, a very sticky portion. So instead of getting 0.2%, we saw 0.3%. And just let me know if you guys like this in the chat as well, this discussion where we move this together. Because if you like this type of thing, we can bring it into these live sessions. Absolutely. It's not a problem, is it, Ty? So, we initially do the reaction negatively. Now, this is what we call a liquidity trap. And it's very classic. Tyron and I say often the first move is the wrong move. A real classic for this is the non-farm payrolls. An event which can be misconstrued in every way you can ever think of. And often the markets will go off in one direction, then they'll reverse. Now, if you ever wondered why that happens, I mean, it's just a number. It's a bad number came out technically, yet the markets went weakness first and then went super strong. And that's to really stop loss hunt people, grab liquidity, because, of course, the market participants want a lot of, volume in orders, and when's a great time to get it during, of course, earnings events, or in this case, news events. And then we go off in the direction above, breaching through what we've been, holding through for quite a long time, which is a consolidation. And now that we've gotten through with such a strong daily close, this would really tell me, Ty, that we're potentially just getting started. We asked before about the inverse head and shoulders, which you all got correct, which is the left shoulder, head, right shoulder. Now, it may not go the full distance of that, but it does seem like it wants to say pullbacks could be met by buy demand, which could push us to that 105.80 previous resistance quite easily, couldn't it?
Absolutely. And it makes sense from a technical standpoint. At the end of the day, we're talking about higher highs and higher lows. Pullbacks to the 20 moving average, perfect example. Yep. And a lot of people say, actually, a lot of the questions that we do get are, will we trade the dollar index? Is that the best instrument to actually trade? But yeah, a lot of people don't probably realize, but we'll certainly let you know now, that if you actually want to trade this particular instrument, sometimes the better way to trade it is actually an inverse version, which is actually trading the Euro USD, which is made up of a significant portion. So if you go to the Euro USD, you're going to see basically the exact opposite. But the great thing about the Euro USD is obviously it's one of the most highly traded currencies in the world. The spreads are extraordinarily tight. Like you Pepperstone traders would know that the spreads get so low on the Euro USD, it's almost zero sometimes. So it's extraordinarily heavily traded. So it's very, very cost efficient to get in and out of. And also it's effectively doing the inverse of what the dollar index is doing. So it's the better instrument to trade generally if you believe there's going to be strength in the dollar index. The Euro USD is your short because, like I said, for trade efficiencies, it's the one that you want to be in, and you're going to have no problems with liquidity on this one, that's for sure.
No, this one's very liquid, and often the pair that most FX traders start with, Ty, or around these kind of pairs, usually they trade their own currencies one, and then everyone goes to the Euro US dollar. And it's a huge chunk of the DXY. So we've seen, look, we're in the downward trend at this stage. So obviously that's significant. I think one thing that is clear after such a big move as this is just because it's a huge move doesn't mean there was actually a lot of trading activity that went through that. So while this dollar index breakout is suggesting at this stage further bullishness for the DXY, weakness for the euro, obviously, that's what the general trend would be. I would watch out for a couple of key zones. In particular, we'd want to set an alert above this 107.27 area because that could tell us that things are at least potentially going bullish for a little while to get back in and test this structure. And what this will do is it will really test this price action. And this price action, while it looks like it probably has a lot of volume on it, probably doesn't have that many trades as it's so quick. So sometimes markets will want to come back, test the area, and then reverse. So someone that's playing chess with the market, Ty, might be saying, okay, well, at the moment, I might have a bearish bias. But because I'm a trader and I'm willing to, admit when things are about to change, if it does breach above this zone, depending on how that looks, I might then think, okay, we're going probably back up to here. And then I might have a bearish bias on it again in this zone based on the previous structure. So from, let's say, this point here, you might be starting to think, okay, during the day, you might be going for the bullish side. From this point here, if it does turn, you might be starting to go to the bearish side. And at this stage, you're probably looking at back down to what we saw before, which is that key support, which is the 10660. So this is all happening here on the markets. And at this stage, I guess on the smaller timeframes, I think 107.266 is a very important level, Ty, and the market's clearly in a bearish bias at this point.
Yes. The dollar index to me has looked like it wanted to pop out for a while now. It's it's been grinding its way up there. Really, for me, once it broke past that 104.20 level, I was starting to get a little bit excited because I think it's got 105 in its sights. And that spells, a 106 something for the euro. I mean, it's already sort of, testing those boundaries now. But I think all we're seeing is probably the fruition of what's been building up already, Tom. And it kind of makes sense from a standpoint. Well, you've got markets at all time highs. You've got gold, trying to reach new highs as well. We will touch on gold in a minute, I'm sure, because it's an important one. That is very heavily traded now. So Yeah, there were a lot of things that were actually very good for the dollar index to actually go long. I think it was just a matter of time before it actually finally broke through, because it was certainly peppering that resistance at around that 104 and 104.20, that's for sure.
Yeah, so euro has a couple of good key levels to be obviously watching again, and I think where you won't probably see a really heavy buyer unless it just turns to this type of structure soon until that 10660, and that should correlate fairly closely with the 10580-ish zone on the DXY. They're kind of synergized together in some ways.
I love that.
Do remember as well,
yeah,
if the S&P tide takes the 20, we're probably going to expect the dollar index to be really moving up quite heavily. A lot of people believe that when the market is starting to weaken, when you initially sell, what are you generally selling into? Cash. So cash can often strengthen as well. That used to be a heavy synergy. It's become less over the years, but it still holds true, at least initially, before people go hedge it with bonds or whatever else they're doing. So before we go to gold, Ty, I want to talk black gold. Oil, of course, because this zone here is another huge level for, I think, so many reasons. And whether you're looking at Brent, which is UK oil, or US oil, either or, of course, on the Pepperstone platform, which you can trade, so like a spot oil or a Brent oil, you are looking at least on the US side, around a 78 a barrel kind of level. Now, why this is so important is because you can see here that there's never been a closure above 78 since we rallied down. So I think a daily closure above this level is going to be fairly big for momentum traders. And people will be looking at this to say, okay, well, maybe we're ready to breach to the next side. And that next side could be around 82 to 84 a barrel. So obviously a weakened oil for a long time, forming a base, having some strong movement in the recent weeks. And if we actually look at the weekly as well, Ty, because I love looking at higher timeframes and lower timeframes, you'll notice here that we came and tapped into that previous demand several times over. And so far, so good. So this is where the bears could sit. So if you're a bear on oil, you're obviously watching this zone, ready to strike, especially scalpers. But if it does breach out, I think that oil could have further rallies on it. And that, of course, would move well with dollar index up, US 10Y up generally. And then you would also see usually oil up, and that would usually have an effect on markets down. I mean, that's just generally the synergy behind the pairs.
Yeah, you're also going to see a pretty strong US dollar CAD as well, if that all eventuates, because it is got strong links to oil. But I think oil, from a standpoint of trading, Tom, even on the smaller timeframes, has been, especially over the last few months, a gift from the heavens, to be honest. I mean, it's been respecting those levels beautifully. The 72 and the 77 have been like a trading zone that's given everybody the opportunity to get in and out relatively smoothly. And you're right, though, it's an extraordinarily important level, and it does move in that $4 to $5 bound. So realistically, if we do get that break above 78, I would be expecting probably 82 to be that level that it would test very quickly. I don't expect it's only going to go 79 and then reverse. I think it would probably push on past the 80 over to the 82 level, which is the next real stronghold for oil. In fact, the 79 would just be a fake out, I think.
Yeah. I really do favor the 82, 84 a barrel as well. I'd love to see that. Right. Gold. Now, this is actually probably the hardest pair to trade. There is a synergy with yields coming out, gold going down, which, if you're not familiar, is something we've discussed several times before. And it's pretty true. I mean, the last 24 hours shows it again, and it makes sense. I could explain it, but I guess I'll explain it briefly. So if you think about it, gold is the oldest currency in many ways. So if you consider gold, when you hold, let's say, billions of dollars of it, you generally have to store it in some kind of safe or bank, and it doesn't really earn you interest. So you've got to think about it from a perspective of interest rates are going up. What about gold? Is gold paying you to hold it? No, you're paying out to hold it. So, of course, the higher the interest rate, technically, to a synergized amount in the current world, if you ask someone, would you rather earn 6% in US dollar or hold gold and earn 0 or maybe even pay 2% to hold it, a lot of people are going to answer, I'd rather 6%. So there is a synergy there with yields, and that's partially what's going on. If it makes some sense, a lot of people don't quite understand that synergy and often misconstrue how gold trades. But that's only a concept. That's a macro concept over a longer time frame. As a trader, you don't really care about that because who cares? I want to know what the price action's doing. Now, why I said gold was hard is because it breached down, and it obviously looks horrible on the chart at the moment. But I think it's in the middle of nowhere land, Ty. At 1989, it doesn't interest me. You get down to this level, which is the price of around 1978. Okay, we're hitting a level of potential demand or support, yeah. But here, I think it's mostly weak,
Gold.
isn't it?
I think gold for me has got two very, very important numbers relative to the area that it's in now, and neither of them are at 1989. 1980 is extraordinarily strong. And then the next level below that is 1950, which is also extraordinarily strong. But you're right, that $10 deviation from 2000, which is also strong, and it is truly in the middle of nowhere, because 1980 and the 2000 are the two bands that I would set around it. And yes, look, was it looking slightly weaker? It was peppering the support at around that sort of 2020 for quite some time. I'm not surprised that it did it. Nothing short of a miracle will stop the 20 and the 50 EMAs crossing on the daily chart to the downside. And that hasn't happened since gold was actually, I think when it happened last, gold was at about the 1950 actually. So it wasn't much different to where it's at now. And it's about to, like I said, it's literally 1 day away from crossing on the 20 and the 50. So I'm not surprised that gold is here, but this is a very difficult area to trade it. You're right. I think that 1950, 1980 are two strong areas to potentially long. But again, it's one of those ones where you got to be patient. I wouldn't be just jumping in and buying it there. I'd wait for momentum to swing. Most definitely.
There's no left-hand side structure here, so we're really in between equilibrium points. Yep. If it does spike, it's more than likely to come off previous resistance points, possibly the 2000, as Tyrone mentioned. And I think that is a bull. If you're a bull maximalist on gold and you've got some really long time frame, maybe you'll like it. But in terms of a trader here, there's not much going on, and it would just be more guessing. And I don't really like guessing.
Exactly.
So you'd have to
when a trade, exactly right. That's 100% right. It can go basically to 2020 just as easily as it can go to 1950. And if you're picking a direction, you're having a guess. So I wouldn't be surprised to see it go in either direction. And if you're doing that, then you're really having a guess. That tells you that it's in the middle of nowhere. Let it get to that destination first, and then look for some structure on the left, or basically on the left-hand side. You need to see something on the left-hand side to warrant why you're trading. If you're ever guessing, look away, Tom. We don't want to do guessing in the market. Absolutely not.
Yeah, no, we don't want to be doing any guessing whatsoever. So I guess it's that time to ask questions of you out there. If you have questions, feel free to put them into the room right now. And we've gone through some of the major pairs, but if there's something you'd like us to have a look at, we'll do it right now together on the Pepperstone platform. And obviously, we'll check that out. Now, in terms of things that I've seen that were pretty good, unfortunately, it's already kind of done it, Ty, but Bitcoin to this level has been something I've been looking for, which is that 51K, and it's actually gone through. It's 51.49. So a strong number here on Bitcoin. After it breached out about a week and a half ago, it's been very, very strong. And this is an excellent level for people to be watching structure as well, because it's bulling into a very, very strong trend and obviously a key level. Another one that I get asked about quite regularly, Ty, has to be the Russell 2000. And that's, of course, the market that has been getting, you would say, arguably thrashed for a while, still being down heavily thanks to its regional bank components. And you can see here it's still down 19.67 away from its previous high. So not too good. Now, the reason I'm going to bring this up is it's just a code that you can do within the platform. And obviously, you can do this within TradingView. And it's what we call IWM, the Russell 2000 versus the SPY, which is just the S&P 500 ETF. So why we're doing this is just as a bit of an interesting long short. You can see here that for a long time, the Russell 2000, in fact, since February of 21, the Russell 2000 has been underperforming the S&P 500. And that's thanks to what we call the Mag 7, which have been doing very well. But recently we came back down to the lows. And I think it's a very interesting level because, of course, around this structure is where you've seen previous buying accumulation. So if you are seeing some type of strength on the Russell 2000, and you're seeing these types of levels as well, that could be a relatively good sign that maybe it's a little bit oversold. And the US 2K, it was looking pretty good, Ty. I actually quite liked its 3-day run here. I thought this was a pretty strong level with buyer demand.
Yeah.
And once it got through that zone, I was pretty bullish on it. And then, of course, CPI is CPI, but it's still around that level. So it's an interesting zone for it. What are your thoughts on the Russell?
Yeah, I do love the Russell. I incorporate that in analysis basically every single day. And because of its tendency to give us an overall picture of what the economy really is doing, I think it's probably the most important thing. I'm not surprised that it sold off more than the other two major indices in the US because of the CPI data. Because you know what, it ran harder than than both of them in the last few days, playing catch up really in my mind on what the other two have already been doing from a performance standpoint. But I think it can often be even though it's lagged the other two indices. Sorry, it's probably a leading indicator to an extent where if it starts to sell off and the other two don't, it does tend to lead sometimes to the other two following it. It, in my mind, gives you a far bigger. Yeah, you're right. The Magnificent Seven isn't the American economy, as some people might think. I'd rather that broader view, and I think the Russell gives you that. So I think even if you don't trade it, I think it's really important to actually incorporate it in at least part of your analysis. Look at the VIX, look at the dollar index, look at the Russell 2000. Even if you don't trade them, get some market ideas and feelings for what's actually happening out there, because they can give you some really good insights into what's actually happening in the markets that you are actually trading, which are obviously generally the bigger, more known markets like the S&P 500 or the Dow 30 or the NAS, of course.
So here's just an analysis, Ty, of the S&P 500 versus the 10-year yield, because of course this is topical to the current situation, and the Russell 2K versus 10-year yield. And we've generally seen the Russell 2K in particular very susceptible to yield issues. And the S&P, as you said, is a bit detached because of the Mag 7. But yeah, the Russell will benefit, you would think, also if yields do start to drop back off. So something interesting just to keep in the back of your mind. There could be a synergy that goes with, of course, price action. After all, they're all just stats. But if you understand a little bit more about macro and how markets kind of can work, then it can be helpful as well when you're making these decisions. So I think the US 2K is an interesting one, Ty. Bitcoin, of course, hitting into a very key zone. And we saw oil, which is probably my favorite of the current potential momentum breakouts. And I really love the S&P at around that 20 moving as well. That's a big level for it. And I think that's an exciting zone. Finally, some action in the index market that's not just bullish.
Absolutely.
All right, so here's some questions coming through. So Oren has here, hi guys, are we in the V right now with the bounce off the 20 moving average? So that's in regards to the US 500. Now the US 500 is, it is bouncing and you kind of expect that. So are you in a V? Theoretically, yes, you're in a small time frame V. And in general, your biggest issue is the 5,000 50-20. Because we know 50-20 is a gap fill and 5,000 is, of course, the psychological level at a 61.8 fib. So, look, do we expect this to be possible and to get back up into this level? I guess so, based on the current tendency of what we call an elastic demand trade here, Ty. But, it's not infallible like anything. I generally would not want to enter usually around here. I would have preferred to have been around that 20 moving average and picked it up at an earlier rate, just because that would have been, generally speaking, a better risk-reward style trade.
I think it's at a very dangerous zone right now. Yeah, like it could flip very quickly and start heading down very quickly. So you want to be careful.
Yes, that's right. I don't think we have that particular stock code at Pepperstone, so we won't probably answer that question, Conrad. But that's if you have a look at it, anything into earnings, generally you're going to be wanting to look at weeklies and those kind of levels. So
just
weekly levels
around earnings,
dailies,
Our general thoughts on earnings is generally we wouldn't trade into them, and we always give them about 3 days after they actually do release their earnings before we actually start looking at them to let the market sort itself out and appreciate what those earnings are and whether they're good or whether they're bad. We don't normally take that first day. We're very careful around that. So generally we apply a 3-day rule around it and let the market settle down and then see if it enters a bit of a trend.
Yeah. All right. Well, from all of us here at Pepperstone, we want to say thank you very much for watching this week's live event. If you did enjoy it, give it a thumbs up. Make sure to subscribe also down below if you want to know when more of these are going live. We do it every week, Wednesday at 8 p.m. Australian Eastern Standard Time, I think, Ty, or maybe it's Eastern Daylight Savings Time. I can't remember. Probably Daylight Savings Time is the one, but it's 8 p.m. Melbourne time. We'll go with that. Melbourne, as Americans call it. And we do it every single week. So make sure to sub, make sure to come along to the events. And we'll be doing this, whether it's a super exciting market on indices or anything else, we're doing it all the time.
There's always something exciting to look at when we're looking at markets every week. So now we've had fantastic feedback over the last few weeks with these live sessions. So we're very, as you can obviously see, Tom and I are very, very passionate about this, and we love to get together and actually talk all things market. So please join us every Wednesday. Put it in your calendar, set your alerts, and definitely give us your feedback on what you'd like to see, because we want to bring obviously the most important information that is relevant to you to the weekly stream. So thanks very much. And are we looking at another one, are we?
I just had to bring up copper because it was asked, and I actually don't mind copper. It does look like it's structurally changing towards the upside. Small time frame stuff only. Obviously, you'd have to proceed with caution. Copper's not necessarily the best trading event because it does have a bit bigger contract size a lot of the time, so be very careful. Make sure to use a demo or something or calculate it correctly. But silver. Copper is there. Oh yeah, silver. Oh, it got me good. Silver. I remember that was like I don't know if they call it PTSD, but maybe that is PTSD in trading. Ty, I'll never forget when I traded the monster lots in silver, and I was like, oh, it was like $700 brokerage, and I was like, no. I was so negative. So negative. And then it moved. And it went to my favorite time. I remember break even was pressed, Ty. Break even was pressed. Immediately get the hell out. Anyway, thank you very much for joining us. We'll see you next week. Quick disclaimer on the way out. And thank you very much for joining us. Bye for now.
Thanks, everyone. Good night.